Felix here, and if you are worried about next week in the stock market, you should be. But let's understand the whys, the what is priced in, what are we expecting, what's actually going to happen, and what are the opportunities. There's always an opportunity in every calamity. If you haven't already downloaded the 736 US listed zombie companies, yes, you'll very likely own at least a couple of these. Then download from felixfriends.org/736 the list and find out the companies that you own that don't have enough cash flow to pay for their interest. That's a big indicator. It's free. It's at felixfriends.org/736. Last chance. Last time I shall mention it. And of course, none of the following is financial advice. You know that already. And you just here for the disclaimers, really, aren't you? I should just make a very long disclaimer video. I think that would be great fun. So who am I? Well, sort of, former economist, a little bit of a banker for a while, a corporate lawyer, that sort of thing. I try to share and explain what actually happens in the market so you can understand it yourself. That's really the whole kind of mantra of the channel here. Is it's all about education. So what have we got? Well, the stock market fell 6% from its June low after this week's sell-off. So we've had a massive massive decline. You can see we're not quite at the June lows, but we're heading that way. And what is very unusual this year is that everything moves together. There's this sort of like groupthink, lemming-like behavior where literally every company out there falls at the same time. So we've got more than 400 S&P 500 members moving in the same direction. Usually that happens pretty rarely. At the moment, it's happening like 43% of the time or something like that. Absolutely staggering. So these kind of all or nothing days are what's giving us these whipsaws, these seesaw effects, and giving us a sore neck. You can also see that when we do have a nice green week like the week before last, we are typically get followed by a nasty one, and you get this kind of zigzag. So if you kind of moderated this out with a moving average line, yeah, you'd get a little bit lower, and then you get a little bit lower here, and then you're sort of still down here, but it wouldn't be quite as wild as the swings feel. So the bear market is very, very erratic. And why is that? Well, inflation at the levels that we're seeing them, I mean, really serious inflation, hurts pretty much everything. If you have high core inflation like we do now, what happens? Well, stocks bleed, commodities do nothing, corporate bonds bleed, treasuries bleed. The dollar is the one thing that actually goes up, and REITs suffer greatly because they typically are mortgage backed, right? I mean, mortgage funded, so they have higher borrowing costs. So unless you are just a US dollar investor, as in you hold a load of cash, you're not really making much money. And then holding cash obviously is a bad idea, but there are other ways to trade the US dollar. So that's really the only thing that's been going up, and that's what we keep seeing. And what does a higher dollar do? Well, a higher US dollar actually lowers stock prices some more, because the big companies, your Microsofts, your Facebooks, your Netflix, all those guys with a very, very international business, which you'd think, well, that's great, isn't it? It means they're more diversified. Yeah, but they're earning euros, they're earning yen, they're earning sterling. You convert that stuff into US dollars and you barely get a penny for the stuff because the dollar is so strong. So that's one of the things that's happening here. So the dollar as an asset class continues to go up, while pretty much everything else is in permanent decline. Even commodities, very, very far off their peaks. Now we're in the 135s. Now we're at about 117 here. So significant drop. The S&P 500 is the red line here. And then US aggregate bonds, really, really bad asset class to be in this year. Although, if you listen to the doom and gloomers, you should have put all your money into bonds at the beginning of the year. I'm not sure what the benefit would have been of that. Now, are we at the bottom of the market? Well, this is well, I was going to say an interesting chart, which typically means it's a terrible thing to look at. What does it say? Well, these light blue lines are the market bottoms. Now, don't try and time the market bottom. It's a futile exercise. But typically, you see the Fed fund rate is actually cut before the market bottom comes in most of the time. Now, I don't think it's necessary, although we have seen it again and again and again. So typically what you see is that if I continue, so the Fed fund rates, say they go up a little bit more, and then you sort of get them flat, and then they start to cut. And then that would typically be your Can we get a straight line? Okay, I moved that line a bit too far off, but you get the idea. So when the Fed cuts rates, you'd kind of expect the market bottom to be somewhere there. Now, I actually think it might happen a little sooner. I think when the Fed starts cutting the rate at which it's increasing rates, I think the market might see that as a positive signal. That could happen in November, it could happen in December. So basically, when we move off the 0.75% rate hikes and we go to half a percentage point rate hikes, and then when we go to quarter percentage point rate hikes, everyone's going to be going, hallelujah. This is returning to normality. And, we've kind of won the inflation story here. Now, one of the big things that really kicked the market last week was Fedex. Fedex warned on profits, and the end is near, and the economy is terrible, and it's all everybody else's fault. Nothing to do with terrible management over the last decade. No, it wasn't us. That was sort of the message. But if you look at what they've done, they've massively scaled the business from a revenue point of view. That's revenue. But they haven't actually made any more money, or hardly any more money. Down here, that's operating profit even. It's not even net profit. So operating profits are basically pretty flat. So what does that mean? Well, it's just idiotic management wanting to build this ginormous, enormous elephant and, going, look, we're a $30 billion revenue business. Isn't that wonderful? No, it's not. You were doing a far better job when you were a $10 billion company in terms of profit margins. So good business, bad business, pretty terrible, I would say. So this is actually why this stock should be coming down. It's that gap. It's just far too large. So if you are invested in a stock that keeps building revenue, and the margins are not improving on the profit side, unless you are in some sort of growth fetish stock, which is fair enough, like a growth tech business, they build revenue first, profits kind of follow from scale. That can be reasonable, but FedEx isn't that. They move parcels. Boxes. It's not exactly a brilliant new scheme of a business idea. So yeah, terrible business to be in. Now, some people keep reminding us of, well, it's going to be as bad as 2000. Do you remember 2000? I do. I worked in a .com company at the time. I remember distinctly a meeting with the venture capitalist who said, no more money. Previously, they've been chucking money at us like it was going out of fashion. So the tech bubble in 2000, the market cap of the top 10 tech stocks, which is, was Microsoft, Cisco, IBM, Sun Micro, all that kind of stuff. AOL, remember AOL? It was 10% of GDP, which was pretty staggering. So where are we right now? Well, at the moment, if you add the top 10 tech companies, they're at 56% of GDP. So is this a tech bubble, or is it a new brave new world we're in? Tough place to look at. It's not exactly the kind of data we like to look at. But having said that, these businesses are by and large very profitable. So, we're talking about Microsoft, Amazon, Facebook, Visa, MasterCard, Google. And yeah, they're described as tech businesses, but Google and Facebook are advertising agencies. Visa is a payment processor that just makes a little bit of money off every payment transaction in the world. Amazon is a retailer / advertiser / data, data center company. So these are not quite the same sort of pie in the sky businesses that we were looking at back then. Something like AOL, for example, which was just, they didn't make any money. And they thought that they owned the internet. They didn't. So yeah, staggering. I think it gives us a perspective of just how expensive tech is. But what I would look at instead, quite frankly, is margins and profits and look at that ratio. And yeah, PE ratios are still pretty elevated. But if you think that they're going to continue to make significantly more money as more and more of the economy moves digitally, I don't think it's as bad as it seems. Now, this, on the other hand, Europe. Lots of articles out today saying, well, Europe's cheap, diversify, go international. Now, Europe has historically underperformed US stock markets very significantly. Why? Because, well, no one really knows what these companies are or where they are. If they're not listed in the US, they get a lot less money. That's a lot to do with it. The demand sits in the US. So that's a big part of it, which is why I typically invest mostly in US listed equities. It's just the biggest market there for the biggest demand side. But certainly European stocks are looking pretty cheap. But there is something to look at here. This is GDP of the major European economies and the Eurozone as a whole here in red. So what can we see with that red number? Well, if we go to the 2008 peak here, the Eurozone's GDP was sitting at about 125, let's call it. And at the moment, it's sitting at 137. So that is 14 years later, and they managed to eke out 12% extra GDP growth. So the GDP is 12% bigger in 14 years. Now, I don't need to tell you that that is a pretty appalling GDP growth. So the problem in Europe is actually stagnation of the economy. It isn't really the energy crisis. Yeah, that's something that's kind of bringing it to a head, but it's a structural problem that's been going on for ages. Lack of innovation, quite frankly. I was funnily enough talking to a robot programmer, engineering chap last night, who's basically saying that's the solution, because he's saying we haven't got enough people, there isn't enough labor around, and they're not quick enough, quite frankly. So we think robots are going to do most jobs, and that's how we're going to go back to growth, which might be a way out. I'm not saying that's the right or the wrong way of going about it, but they need a serious innovation kick, and at the moment they're not. Massive bloated governments and so on. But all right, what we are here for is not to lament the state of the European economy. We are here to make sure we're prepared for next week. Are you prepared for next week? Well, on Wednesday, and I'll be live streaming this, of course, we get the rate decision at 2 p.m. Eastern on Wednesday, and then at 2:30 p.m. Eastern, we are getting the press conference, very important. And then the next morning at just before the market opens at 8:30 a.m., we're getting the initial jobless claims data out. Apologies, my dates, my times are Monaco time, so ignore those. Unless you are based in France or Central Europe. So the initial jobless claims are also kind of the kick after the Fed press conference right the next morning. So I think it typically takes the market about 24 hours to absorb this data. So bear in mind, whatever you're doing, whatever you're investing, if you're trading options and so on, it might be a good idea, at least on Wednesday morning, to have a look at your portfolio and de-risk. And that's certainly what I'll be doing. And I'd encourage you to do the same. Though, what I would really truly encourage you to do is come and make some money. Learn with us, learn with the community. We've got 2,700 students in the academy. The GOAT Academy Master Options is our program. FelixFriends.org/options. There's a coupon code there, Build Wealth, that expires on Monday, I believe. FelixFriends.org/options is where you go. And what does it teach you? Well, it teaches you how to build another income stream from trading options. It takes me about 3 hours a week to do so. So it isn't particularly time consuming. Is it difficult? No, but you have to learn it. It isn't like a sort of common sense either, but there's a strategy. It's about strategy. It's not actually learning about what options are, but if you are, selling covered calls or buying puts or buying calls or buying leaps, God forbid, then I'd recommend you learn how you actually make money, because you are either gambling or you are. Covered calls are not terrible, but they're just not very profitable. So I would change tact and become the sort of trader that Wall Street brings about. So if you look for options, check it out. I appreciate you watching. If you enjoy these kind of rather longer macro updates, let me know down below in the comments, or if you fell asleep, also let me know, and I shall adjust accordingly. Thank you very much for tuning in.